Welcome back to the deep dive. We're here to take that stack of sources you have and really make sense of it all. Today, we're looking at Avantis, ticker AVNT. And wow, they've been in the spotlight lately, haven't they? Big institutional interest meets some pretty serious market swings. I mean, the token, AVNT, it dropped almost 45% in just 1 week recently. That's brutal. But here's the kicker from the charts we looked at. It bounced right off that key $1 support level. And it actually broke out of a downward trend channel.
Yeah, exactly. Classic potential reversal signal right there. So our mission today is really to get past just that price chart drama. We need to dig into the technology, the financial setup that's pulling in big money. Even with that kind of volatility, is this thing built to last?
Right. Is the foundation solid?
They've got a good mix of material. Technical analysis from just this month showing that breakout, but also, the really dense stuff, MiCAR regulatory filings, summaries of their funding rounds.
So market moves and the fundamental structure. Got it.
We're getting the full picture, hopefully.
Yeah. Okay, let's kick things off with segment 1. What is Avantis? The sources call it DeFi's universal leverage layer for real-world assets, and they built it on Base.
Yeah, and that choice of Base, the Ethereum layer 2, that's pretty important. It means they get Ethereum's proof-of-stake security, which is robust, but they also get the speed and low fees of an L2.
Which you absolutely need for a derivatives platform, right? High-frequency trading.
Exactly. You couldn't really do this efficiently on Ethereum mainnet. The L2 makes their whole model viable.
And the big hook is the RWA-focused real-world assets. This isn't just trading Bitcoin or Ether perps. They're offering leveraged futures on Forex pairs, gold XAU, crude oil, even U.S. stock indices like the MEG7, Koyan stock. It's a wide range.
A very wide range. And yeah, the leverage goes up to 500x.
500x, that jumps out immediately.
It's definitely a headline number. It catches the eye of, the high-volume traders.
Yeah.
But beyond the number, think about the challenge they solved. Getting reliable price feeds for all those different assets onto the blockchain securely. That's the tricky part.
Okay, 500x leverage sounds like amazing capital efficiency on one hand, but also potentially a massive risk if things go wrong. Does that high leverage scare off the serious liquidity they need?
That's a really good question. It touches on their whole risk management approach. They seem to be catering to the risk takers with the high leverage, but then providing these structured safety measures for the liquidity providers. We'll get into that. But the market seems to like it so far. Since the mainnet beta kicked off, February 2024?
Yeah, February this year.
They've apparently processed over $22 billion in trading volume. Serve more than 41,000 traders.
$22 billion in, 8 months? That's huge.
It is. And that's why the sources are calling them the biggest RWA leveraged DEX and, the biggest DEX overall on Base right now. So clearly there's demand.
Okay, demand is there. Let's get into the mechanics now because the Zero-Fee Perpetuals thing, the ZFP model, that sounds revolutionary. Zero fees. How do they make money?
Right. Sounds counterintuitive. But the ZFP model, it really does flip the script. Normally, you pay fees to open, close, maybe borrowing fees. Doesn't matter if you win or lose.
The house always gets its cut.
Exactly. But here, traders pay literally 0 fees up front. Nothing. Fees only get charged if your trade makes a profit.
So if I make a bad trade and lose money, Avantis gets nothing from me on that specific trade.
That's right. The protocol's income is directly tied to user success. They win when you win.
Okay, so their incentive is to make the platform good enough for people to actually be profitable.
Precisely. And that's where the sustainability argument comes in. They're not scraping tiny fees off every single transaction. They're aiming to take a percentage of the aggregate profits generated across their massive trading volume. High volume, profitable traders, that's their goal.
That must make strategies like high-frequency trading much more appealing. But they also have other ways to nudge trader behavior, right? Something about protecting contrarian traders.
Yeah, they do. It's about balancing the open interest, basically.
Yeah.
If you bet against the crowd, you go short when everyone else is long and you end up losing money on that trade. The protocol might give you what they call loss protection, up to a 20% rebate on your loss.
Interesting.
And on the flip side, if your trade helps balance out the protocol's overall risk, you can get rewarded with positive slippage. It's all financial engineering to try and keep things stable.
Stability brings us to liquidity. How do they handle that? The sources mention a universal vault, one single vault for everything.
Yeah, one aggregated vault based in USDC.
But how does one pool of USDC act as the counterparty for trading, crude oil and crypto and gold? That seems
Those have
Complicated. Usually liquidity is siloed.
It usually is.
Yeah.
This is where the idea of synthetic liquidity comes in. Think of the universal vault like a big central insurance fund. Instead of needing a separate pot of money for gold USDC trades, another for oil USDC, another for ETHUSDC, the vault kind of nets out the risk across all 80 plus markets. It synthesizes the exposure. This makes the liquidity incredibly efficient. That's how they can support, $22 billion in volume with around $18 million in TVL locked in the vault.
Okay, the efficiency makes sense. Huge boost there. But if it's all one pot, what about the liquidity providers, the LPs? If there's a huge crash in, say, the crypto market, does an LP who thought they were just providing liquidity for Forex suddenly take a massive hit? That feels risky for LPs.
That's the key problem they had to solve for the LPs. And their solution is pretty innovative for DeFi. They brought in risk stratification like you see in traditional finance. They split the vault into two parts, a junior tranche and a senior tranche.
Okay, a dual vault system. Tell me about that split, junior and senior. How does that work?
So DigiTranche takes on more risk. It absorbs up to 65% of any potential losses the entire vault might suffer. But in return, it gets 65% of the commission income generated.
Higher risk, higher reward.
Exactly. Then the senior tranche is the opposite. It bears only up to 35% of the potential losses, so it's much safer. But it only gets 35% of the commission income.
Lower risk, lower reward.
Right. And this is a big deal. It means LPs can actually choose their risk level. If you're comfortable with more risk for potentially higher returns, you go junior. If you're more conservative, maybe institutional capital looking for steadier, safer yield, you go senior.
That ability to choose your risk exposure.
Yeah, that sounds very TradFi, very structured.
It's definitely bringing that kind of sophistication on-chain.
Which leads us nicely into segment 3, the money behind it and the push for compliance. This clearly isn't just a couple of developers in a garage.
No, absolutely not. The team behind it, Lumina Labs, they've raised $12 million in total funding.
Okay.
That includes a $4 million seed round back in September 2023, and then an $8 million Series A just this June 2025. So consistent backing.
And the names involved in those rounds are serious. Pantera Capital, Peter Thiel's Founders Fund.
Dragonfly, the base ecosystem fund.
Yeah.
Yes, top-tier VC money. And the team itself, the sources mention people with backgrounds at Pantera, Goldman Sachs, Jane Street, McKinsey, Barclays.
Right. These aren't just crypto OGs. You've got serious traditional finance experience building this. Wall Street moving into DeFi.
And that kind of backing, that kind of team probably explains their focus on regulation, right? The MiCAR White Paper.
Definitely. They've clearly put a lot of effort into structuring their documentation to align with the EU's MiCAR regulation. That's the Markets in Crypto Assets Framework. Regulation EU 2023-11-14, I think.
So they're signaling they want to play by the rules, aim for mainstream regulated adoption.
That seems to be the long-term goal, yes.
But okay, we have to talk about the disclosures in that MiCAR paper, because while it shows ambition, it also lays out some pretty stark warnings for users.
Extremely important warnings. And you, the listener, really need to pay attention here. The documents state very clearly, this white paper has not been approved by any official EU regulatory body.
Okay, so it's their interpretation, not an official blessing.
Correct. And crucially, for anyone putting money in, the crypto asset itself, AVNT, is not covered by the standard EU investor compensation schemes, Directive 9790C, or the deposit guarantee schemes, Directive 2014-49 EU.
No safety net there.
None of the traditional financial backstops you might expect in the EU. And they explicitly state the token might lose its value partially or completely.
So you've got this Wall Street caliber team building the platform, but the actual investment is still operating in the wild west of crypto risk when it comes to protections.
That's a good way to put it. The platform structure is sophisticated, but the external safeguards aren't there yet.
Okay. One more compliance point from the source's energy consumption. MiCAR requires reporting on that, right?
Yes, environmental impact. And because Avantis runs on Base, which is proof of stake.
It's very energy efficient.
Exactly. Their estimated annual energy use is tiny, something like 300 to 600 kilowatt-hours. That's way, way below the MiCAR threshold for needing detailed impact reports, which is 500,000 kilowatt-hours per year. So building on an L2 basically solves that climate disclosure requirement for them.
Makes sense. Okay, let's shift focus to the token itself, AVNT, the thing that's been bouncing around in price.
Right, the AVNT token. It's an ERC20 standard utility token, fixed supply, 1 billion max. Its main uses are twofold. First, governance holders get to vote on changes to the protocol, standard stuff.
Okay.
And second, it functions as a work token. This is maybe the more interesting part.
A work token. How does that relate to the stability we talked about, especially since there are no EU guarantees? Does the work token act like an internal insurance fund?
In a way, yes. It's the internal mechanism providing security to the LPs, the ones in that universal vault. People stake their AVNT tokens, locking them up. By doing that, they're essentially putting their own capital on the line. They accept the risk of being slashed, meaning their stake tokens can be taken away if the protocol runs into major, unmanageable losses.
So they're the first line of defense if the LPs face losses.
They are. And in return for taking on that pretty severe risk, the stakers earn rewards from the protocol's revenue. It's very similar to how Aver's safety module works. It makes system stability something that's actively maintained and incentivized by the token holders themselves.
Got it. So the sophisticated risk tranching for the LPs relies on the willingness of AVNT stakers to potentially take the hit first. It's all interconnected.
Yeah, very circular system, yeah. And regarding how the tokens are distributed, they allocated just over half, 50.1%, to the community and ecosystem growth. The rest, 49.9%, is for the team and the early investors. But it's subject to pretty long vesting periods, like a 12-month cliff, then vesting linearly over 30 months.
Trying to prevent early dumping and encourage long-term alignment.
Seems to be the goal. Align incentives.
Okay, so let's loop back to where we started that market action from early October. The 45% drop, then holding $1, then the breakout. That seems pivotal.
It really does seem like a key moment, according to the technical analysis source. That $1 level holding, despite the massive sell-off, showed real buyer conviction.
A psychological floor?
Could be. And then breaking out above that descending channel. That immediately signals the previous downtrend might be over.
And were there specific indicators flashing green?
Yeah, the source mentioned the Awesome Oscillator, which measures momentum. It apparently started printing green bars, even while still negative, suggesting the downward pressure was easing up significantly.
Okay, momentum shifting. What about sentiment? How are people talking about it online?
That shifted too. The on-chain weighted sentiment metric, which kind of tracks the mood in social discussions about the token, it bounced back into positive territory, hitting a 1.10 rating.
So the technicals improved and the community mood got more optimistic right after that big washout.
Exactly. It suggests the market started looking past the short-term panic and perhaps back towards the fundamental strengths we've been discussing, the tech, the team, the funding.
So if the charts, the sentiment, and the fundamentals seem to be aligning after that drop, what are analysts looking at for potential price targets now?
Well, based on that breakout structure, the immediate resistance level mentioned is around $1.54. That's the first hurdle.
Okay.
If the positive momentum continues and the market keeps valuing that institutional story, the more bullish scenario points towards a potential move up to the $2.06 area in the short term.
So the volatility might have just been a reset before potentially recognizing the underlying value proposition.
That seems to be the interpretation in the analysis, yeah.
Okay, this has been a really thorough look at Avantis. Clearly a major player trying to bridge RWAs and DeFi derivatives, powered by that zero-fee model and some very serious institutional muscle.
And they're not stopping. The roadmap mentions Avantis V2, aiming for like 10x capital efficiency improvements.
Wow.
Launching their own dedicated EVM chain, presumably for even faster, cheaper transactions, and expanding the RWA listings even further, aiming for over 100 assets.
They really are going for that universal leverage layer title.
It seems like it. Global ambitions.
So let's wrap up with a final thought for the listener. We've seen this sophisticated architecture, the focus on sustainability, the profitability they claim. What does this model mean for the future of trading on-chain?
Well, here's something for you to really chew on. Avantis is designed to be self-sustaining, profitable only when its users are profitable, thanks to that ZFP model, and it offers liquidity providers this really granular TradFi-style risk management through the dual vaults. So the question is, does this combination aligning protocol profit with user success and providing clear risk choices for capital, does this represent a better blueprint? Is this a more sustainable, maybe even fairer model for decentralized derivatives compared to some of the earlier DeFi protocols that often felt stacked against the user?
A system designed for stability from the ground up, using lessons from traditional finance but built on crypto rails.
Exactly. Is this structured approach, backed by institutional know-how, the way forward for making on-chain derivatives truly mainstream and perhaps more resilient? It could fundamentally change expectations for DeFi protocols.